Hello, my name is Eddie Tofbik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. Unlike some of the other grain markets, we did not really have a double top pattern here, lopsided or otherwise, in the recent past. What we did have was a mid-February to late June uptrend, now broken, that looked like it might have been part of a very big February to late June bull channel. However, this bull channel is no longer valid, though I do note the market did try to run along the underside of this broken lower bull channel line for a little while. We nevertheless have seen a somewhat imperfect stalling of the drop when prices moved down to the 208-2012 area, thus giving the impression of action since the end of May, and here I quote from last week, being a possible hesitation, even perhaps a halfway hesitation pattern being constructed, or alternatively, and this is important, a possible diamond pattern being formed. If this hesitation will truly become part of the corrective hesitation in a large mid-May to date action, then we have possibilities of prices initially reaching 204.25 once again, which is not too far and ties in with the lows of May and April, as well as the congestion seen between December 2018 to February 2019 between 204 to 208. So perhaps this might be a bit more substantial as support, as it might seem at first glance. Notwithstanding this somewhat ancient support, the secondary harder possibility, which is still a possibility, is down in the 194 zone. End of quote. Now, I continued last week, and I quote, much as I said on Kansas City wheat, this idea of a hesitation or diamond pattern continues to be early speculation on my part. And it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. I am not happy about calling any bearish pattern as yet, and will thus hold off clarifying any targets below once again. End of quote. Looking back, I'm glad I held off clarifying any downside targets, as instead of a bearish halfway hesitation, we had a gapping higher diamond pattern. A primary target in the 223.5 area, a target already reached, just about, and a secondary harder to reach target X up in the secondary target further higher up, which I will deal with shortly. So not too far above. And if the market pushing up through it, both the interesting 50% absolute Fibonacci line at 218.75 and the May 23 low at 221.25, those are not stabilizing, but we are over the latter. So it is a diamond bottom pattern. Doesn't look like it's a false break, and we've reached the targets for it. Minneapolis wheat. The hesitation seen since the end of May to mid-June was centered around and rotated about the mauve medium moving average, currently 655, as well as the congestion area 650 to 651.75 around the August 2018 high 650 plus, outlying the April 24 low at 634.75 on the downside. Prices settled on and around all these for a little while and even created a weekly key reversal up 2 weeks ago. However, as I said a few weeks previously in my Kansas City week commentary, and I quote, I was suspicious of it, this is the weekly key reversal up, because I also detailed what I thought would be some more forceful patterns in operation, especially on the downside. You see, this move lower, much as in Chicago, we opened up the idea of a possible mid-April to date double top pattern. Though I have to admit is one very, very lopsided double top. End of quote. This is exactly the same situation here in Minneapolis wheat, but with a little more advanced. I spoke about this 5 weeks ago when I said, and I quote, the importance of this 50% Fibonacci line, so that is the 50% Fibonacci line of the May to August 24 move at 669.5. The importance of this 50% Fibonacci line is that it is also the base of a mid-April to date double top, Adam and Eve type. And the break below the 50% Fibonacci line is the follow-on move lower. Thus for this pattern we have a primary target X2 down in the 635.25 zone, right on the April 24 low, with a secondary harder to achieve target X3 down in the 606 zone, right on the April 21 low, end of quote. 3 weeks ago we saw that leap lower down to the target to the April 24 low, and 2 weeks ago prices even went further through target X2 at 635.25 and down to the secondary harder to reach target X3 down at 606 even, and below the slowly rising gold long moving average, which is currently at 617, as well as the October 2018 high at 611 even, to land on that April 21 low at 606. And this is where I deal with that hesitation seen earlier over most of June. It was, as I said 3 weeks ago, and I quote, because if it is a corrective hesitation, then we might possibly have a larger move lower from the end of May to date action of initially a possible move down to around the 618.25 area, and a secondary harder possibility of a move down to around the 569.5 area. These are not targets yet, just possibilities, and will only happen if what we see this past week or so is a corrective hesitation. However, much as I said in Kansas City Week and in Paris Milling Week, this is early speculation on my part, and it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries, end of quote. Well, the initial possibility around the 618.25 area was easily reached, leaving us with the secondary hard to reach possibility, now a secondary target X4 down in the 569.5 area. Now, I spoke on this last week when I said, and I quote, I have to say this is a big drop down for the market to swallow, given the congestion we have in the market prior to the US-Iran war, between about 595 down all the way to 570. But for now, I'll still label it and lay it out there as a possible, much harder to reach target. Target X4 now looks highly unlikely, and I'll retire it after this commentary. I further added last week, and I quote, one new feature, and it only applies to this market rather than to other grain markets, with a possible late May to date quite acute bear channel. It's currently 543 to 599.5. I've drawn it highlighted in dark blue, but I am very, very cautious about it. In part it's because it's too steep an acute bear channel, and in part because it is really only a 3-touch pattern rather than a hoped for 5-touch pattern. As I suspect the piercing of the upper bear channel line done yesterday, especially so close to the virtual flatlining gold long moving average, well, it might possibly be the undoing of this pattern. Watch this space. End of quote. Well, I am glad I said those words, as prices have risen from that break over the dark blue bear channel, and today are challenging the rising mauve medium moving average, currently 655 even, as well as that previously mentioned congestion around the 650 area. Behind the current market, we have left a V bottom below us over mid-June to mid-July, and prices now have in their sights the overhead declining green short medium moving average, which is currently at 668, and the 50% Fibonacci line of the May to August 24 move at 669.5. This V bottom prompts me to consider whether this pattern will have a handle to the pattern, a period of sideways movement as it finishes its upward construction. So please pay special attention to the possible construction of this handle, or extension as sometimes called. Interestingly, we had such a handle during June going into this V-bottom pattern, which is a rarer form, but one that is interesting. London UK Feed Week. As I have repeated here for months and months, there are two key long-term patterns here to bear in mind. Common neckline extension, which is highlighted in dark blue on my daily chart, and that's currently at 169.35. I will shortly detail these patterns, but first I would like to discuss the recent action over late April, May, June and now July. First off, we are still within the purple end of June to late October 2025 bullish shift pitch wall, reaching up today to touch the purple middle time, currently at 186.35. However, the main recent pattern we created had been the late April to late May head and shoulder top. We broke down through the neckline of this pattern 6 weeks ago and reached down to both the primary and hardest to reach secondary targets easily enough. Last week I thought the action since the start of June was either forming a possible bearish halfway hesitation or not. It's too early to really say last week, as prices had dropped down to just above the very interesting combination of that flatlining gold long moving average, currently 169.85, and that earlier mentioned dark blue neckline extension. Now, I did say last week, and I quote, we would have an initial possibility down to the 170 zone, close to that key neckline extension, and the slowly rising gold long moving average, plus a harder to reach secondary possibility down in the 162 even zone, where we have the congestion from autumn and winter 2025 and spring this year. These are not targets yet, just possibilities, and will only happen if what we see developing throughout June becomes a corrective hesitation. However, much as I said in Kansas City week and Paris Milling week and also in Minneapolis week, this is early speculation on my part and it may not happen. I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. End of quote. Now I know that's quite a lot to digest, especially as prices dropped down to the initial possibility, bounced into a small double bottom and have risen since, such that those possibilities below, well, they are swiftly becoming just memories. As prices shot up today through the mauve medium moving average, which is currently 176.25, the 50% absolute Fibonacci line at 180.5, and the green short medium moving average at 180.90. We now have overhead just beyond the purple middle tine. We have the bright green neckline extension, currently at 187 even, of that small but important head and shoulders top, seen over late April to early June, with the congestion up there that the head and shoulders top created. Yet what I'd like to do is also consider why we had that congestion up there in the first place, and that is due to the bright red neckline, a little higher up, of the big in price, if not time, so it's big range but not necessarily in time, March to May 2022 head and shoulders top, which is currently at 194.25. That one is worth considering and watching carefully. Now, with all this in mind, please let me now discuss the longer term points once again. The same points I've been discussing here for, well, over a year and a half, as some of them were things that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for two patterns. A very large May 23 to April 25 bearish cat's ears pattern, which is akin to a double top but formed after a big fall, such as the fall we had in early 2023. As well as this, we had an even longer term second pattern, an August 20 to April 25 very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart, currently 169.35, the same as on the daily chart I just spoke about. Now, the bearish cat's ears pattern, its time has come and gone, and the longer term head and shoulders pattern, well, it's still a live pattern, but it looks very, very sick. Back when I saw it first, I gave it a primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 250 or so charts. It's the 1975 to date. Yes, a half-century old uptrend, currently at 66.35. I am not even going to give you my secondary harder achieved target for this pattern, as it's below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years, but for now they are still targets below. But I'm seriously considering retiring them now. Now, that all being said, July 2025 will change over through a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5, and just under the bright green 2023 to date upper bear channel line, which is currently at 167.65. The question this posed, and it's a longer term question, was whether July 25 was just a reactionary single month move higher or the beginning of something else. I've said for about 4 months now that these two bearish patterns will not be the way forward, and that what we have is a base for a move higher. March provided a single monthly close barely over the bright green upper bear channel line. April did much better with a clean clear close higher. However, I have said repeatedly that I would like to see a minimum of at least one more month. Ideally, the close of May would have been it over the bright green upper bear channel line to verify this move higher, and ideally over the 50% absolute Fibonacci line at 180.5. Well, we saw that strong close for May, but the pattern for May was a bearish one, a shooting star pattern, type 1 bearish, and June just formed a bearish open and close black Maribosa, tempting the bright green upper bear channel line as well as the purple neckline. But though it is early, July is putting forward a strong move higher, and the time to consider what else may be here is getting closer. It raises the question here, as I said last week, and I quote, as to whether the whole 2023 Today action could be the start of yet another pattern, perhaps an opportunity for a very large reverse head and shoulders pattern. So watch this space carefully, as time will tell. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.